Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in financial filings. Are we about to see a company that is playing it safe, or is their financial report going to be a wild ride? Alright team, let us decode the latest financial report from Provident Financial Holdings Incorporated. This is their quarterly update, a 10Q filing, and it gives us a snapshot of their business performance at the end of last year. The company we are looking at today is Provident Financial Holdings Incorporated, ticker symbol PROV. They are a financial institution, and like many banks, their business is all about managing money, lending it out, and keeping it safe. First up, the snapshot of how the company stands financially. This is like the company's balance sheet showing us what they own and what they owe. At the end of December 2025, they had total assets of about $1.23 billion. That is a lot of money, and it includes things like cash investments and importantly loans they have made to customers. Looking at their assets, their loans held for investment were the biggest chunk of their business at over $1 billion. They also have investment securities to generate income. Now let us talk about where their money comes from. Deposits are the lifeblood of a bank. They have over $872 million in total deposits from customers. A good portion of that is interest bearing, but they also have a significant amount, around $75 million, in non-interest bearing deposits, which basically means customers are keeping money in their accounts without earning any interest. A very good deal for the bank. On the other side of the coin, they have liabilities totaling over $1 billion. This includes all those customer deposits and other borrowings. What is left over for the owners or stockholders is around $127.5 million. This shows us the value of the company that belongs to its shareholders. Now let us dive into how they made money and what they spent. This is the income statement for the quarter and the 6 months ending the 31st of December 2025. The core of a bank's earnings usually comes from net interest income. This is the difference between the interest they earn on loans and investments and the interest they pay out on deposits and borrowings. For the 6 months ending December 2025, this was about $17.8 million. This number here is crucial because it shows their basic profitability from their core lending and deposit taking activities. This is interesting. They recorded a recovery of credit losses of $784,000 for the 6 months ending December 2025. This means that previous estimates for bad loans turned out to be higher than the actual losses, which is a positive sign. The previous year, they had a provision for credit losses, meaning they expected to lose money on loans. So seeing a recovery is quite a turnaround. Non-interest income comes from things like fees for banking services. For the 6 months, this was about $1.7 million. This is important because it shows they are not solely reliant on interest income and have other revenue streams. Operating expenses are always a key area. Salaries and employee benefits were the largest expense at $9.5 million for the 6 months. Managing these costs is vital for profitability. All of this comes together to show their net income. For the first 6 months of 2025, they earned $3.1 million. This is up from the same period in the previous year, which shows some positive growth. This translates to basic earnings per S-share of 48 cents for the first 6 months of 2025. From a shareholder perspective, this is a key indicator of profitability for their investment. Looking at the equity statement, we see how the owner's stake in the company has changed. They repurchased treasury stock costing $1.5 million during the 6 months ending December 2025. This means they are buying back their own shares, which can sometimes boost the value of the remaining shares. The company paid dividends to its shareholders. For the quarter ending December 2025, they paid 14 cents per S-share. They also paid dividends for the 6-month period totaling 28 cents per S-share. Returning value to shareholders is a common practice for stable companies. The cash flow statement tells us where the cash came from and where it went. This is really important because a company can be profitable on paper but still have cash flow problems. Their operating activities provided $3.7 million in cash for the 6 months ending December 2025. This is a good sign indicating that their core business operations are generating cash. In investing activities, they had a net decrease in loans held for investment of $8 million. This means that principal payments from existing loans were higher than new loan originations, which contributed to the decrease in their loan portfolio. On the financing side, there was a net decrease in deposits of over $16 million. This tells us that more money was withdrawn by depositors than was deposited. This is common when interest rates are fluctuating and people are looking for better returns elsewhere. At the end of the period, they had over $54 million in cash. which is a healthy amount for a company of this size, indicating they have enough readily available funds. Now let us look at some of the notes to the financial statements. These provide more detail and context. The company operates as a single reportable segment, a broad range of banking and financial services. This means they are not diversified into wildly different businesses, so their performance is largely tied to the banking industry, specifically in their local market. They are also talking about a new accounting standard update, ASU 2025-08, which relates to how they account for credit losses on financial instruments. This is a complex accounting change that aims to simplify how they handle purchase loans. They are still evaluating its impact. Earnings per share or APHES is a critical metric for investors. For the quarter ending December 2025, their diluted EPS was 22 cents. For the 6 months, it was 47 cents. These numbers show how much profit is attributable to each share of common stock. They hold investment securities. At the 31st of December 2025, they had about $100 million in investment securities. A significant portion, about $8.3 million, had unrealized losses. The company states these losses are mainly due to interest rate changes, not credit quality issues, which is reassuring. They do not plan to sell these securities at a loss. Coming back to loans, their total loans held for investment net of the reserve for credit losses was a substantial $1.037 billion at the 31st of December 2025. Loans are their main asset. Within their loans, commercial real estate loans total about $70.9 million. They specifically mention the office sector within this category faces elevated risk. This is an important detail showing they are aware of potential trouble spots in their loan portfolio. Looking at asset quality, their classified loans, meaning those with potential credit weaknesses, were only $2 million at the 31st of December 2025. This is a very small percentage of their total loan portfolio, which suggests good overall asset quality. Non-performing assets, meaning loans that are not generating income, are very low at just $990,000. This is an excellent sign of a healthy loan portfolio. Non-performing loans as a percentage of total assets are a tiny 0.08%. Now for the management's own commentary on their business, this part is usually more forward-looking and provides strategic insights. They operate in a single business segment, primarily community banking, and their strategy is focused on moderate asset growth and improving their deposit base by shifting towards lower cost accounts. That is a smart move to improve their profit margins. They highlight risks including adverse economic conditions in their local markets and changes in interest rates. These are standard risks for any bank, but it is good they are explicitly mentioning them. This also points to a notable risk regarding the broader banking industry sentiment. If other banks face trouble, it can affect how people feel about their own bank, even if their financials are sound. They have around $213 million in borrowings with the FHLB of San Francisco. This is a crucial source of liquidity for them. A key takeaway here is that Provident Financial Holdings Incorporated ended 2025 well above regulatory capital requirements. This means they are financially strong and not at risk of regulatory intervention regarding their capital levels. This is a sign of financial stability. Looking at the whole picture, Provident Financial Holdings Incorporated seems to be managing its business prudently. Their loan portfolio quality is impressive with very low non-performing assets. They are aware of risks in specific sectors like commercial real estate and are taking steps to manage them. Their financial performance shows modest improvement in net income and earnings per share. The company appears stable and focused on its core banking operations. A key strength is their strong capital position and their disciplined approach to managing interest rate risk. The main risk they face, and quite frankly most banks face, is the broad economic environment and interest rate fluctuations. What do you think about Provident Financial Holdings Incorporated's latest financial report? Can they sustain this performance in a still evolving economic landscape? Let us know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button, it really helps us out. Subscribe to Corporate Decoder for more deep dives into financial reports so you do not miss our next video. And for more immediate insights and to chat with us about these filings, join our Discord community linked in the description. Thanks for watching. See you next time.